Hi, welcome back. I'm Matt Fisher, your accounting professor. In today's lecture, we're going to go over the statement of cash flow. So there are 4 financial statements. In the past, we've gone over the other 3, and today we're going to concentrate on the statement of cash flows. This is going to be a 2-part video. So the first part we're going to look at is the direct method. So before we get started in that, let's give you some background. Why do we need a cash flow statement? Well, the other financial statements are basically based off of an accrual basis accounting system. Well, we want to know what's really happening with cash, and that's what the cash flow statement's telling us. So suppose that last year we ended the year with $100,000 in cash. And at the end of the current year, we have $150,000 cash. So we went from $100,000 to $150,000. So cash increased $50,000. But why? How did it increase? We'd like to know what took place in the business to make that happen. So that's what this statement tells us, where this cash actually came from. Now, like I said before, in this video, we're going to go over the direct method. There are 2 methods, the direct method and the indirect method. The direct method is easier, but actually most businesses use the indirect method. All right, but let's go over this direct method first. These financial statements are actually fairly similar. They're both broken down into 3 sections. There's an operating section, so let me write that on the board. And in this operating section, this is where we have the transactions, or the cash transactions, I should say, that the business does on a normal basis. It's what the business does for their business, all right? So in the operating section, you're gonna see such things as the cash received from customers, the money that we paid for inventory, how much we paid our employees. Those are all operating type activities. The next section is the investing section. So this business invests in things, possibly. Okay, most businesses will invest in computers, buildings, equipment, machinery, okay, trucks, cars. These are all investments that they make in the business. But they need these assets. They need to invest in these type of assets in order to do their business. They might also purchase stocks and bonds, all right? Maybe they have some excess cash, so they want to invest in some stocks and bonds. So those types of investments would also be investing activities. So if they purchase a new building or purchase new computers, that's investing. That's cash going out, right? So cash is going down because we're purchasing this. If we were to sell one of our plant assets, if we were to sell some equipment, then we would get cash in. So that would affect this by cash going up. Okay, so this direct method, we're just looking directly at what's taking place and reporting it from a cash basis. Cash going up, cash going down with each of these sections. Now, the third section is the financing section. How does this business finance itself? So what I like to tell students is, well, imagine that you're just starting this business. So when you're just starting a business, you need some cash. How do you get that cash? Well, either the owners invest, right? Possibly issuing stock, the owners invest in the company, or we can go to a bank or some sort of financial institution and borrow money. So that's what financing is. So if we issue stock, cash goes up. So this would be an increase in cash if we issued stock. If we paid dividends on those stock, that'd be cash going down. If we borrowed money, cash going up. So if we borrowed $100,000 cash, cash goes up. If we repaid $20,000, cash goes down in the financing section. So now you can see these 3 sections, these 3 type of activities that take place in the business. The normal operating thing that the business does, investing, how we invest our money, okay, and lastly, how do we finance our business? And all 3 of these are taking place all the time, all right? So that's the direct cash flow. We'll start with titling our cash flow statement, giving the company name, saying it's a statement of cash flow, saying it's for the year of whichever year we're working on. And then we would have activities with operating, activities with investing, activities with financing. And then once we summed all these up, we would get a total, all right? So let's just say in my example, because remember cash went up 50,000, so we're going back to the very beginning of the video. Then the cash balance, I'm going to abbreviate here, for the prior year, remember I said was 100,000? So there's the 100,000. So then from the prior year, the prior ending year, so now the cash balance at the end of the current year would then be $150,000. Let's stop there for this video. Like I said, this is the direct cash flow method. In the next video, we're going to go over the indirect cash flow method, which is a little bit trickier, but you're going to see that the investing and financing sections are exactly the same. It's not going to change. So what we're going to concentrate on the next video is the operating section for the indirect method. All right, class, I hope this video has helped you. I hope to see you again in future videos. Good luck in accounting.